All right. Hello, everybody. Happy Friday to you all. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. What I want to do with today's session, we've had a very active week market-wide. I want to talk through some of the key markets that we're tracking here going into next week, which is shaping up to be another very active week. We got through the big earnings releases here this week. The big session was yesterday after the close. We had all of the big tech names, Apple, Amazon, Google, Facebook. They all released their earnings last evening. And for the most part, pretty disappointing, at least the market's reaction to those numbers. The underlying earnings were actually pretty decent when you look at them. But you have to remember that those names have moved so far, so quick. A lot of them were overbought going into the releases. It just turned out to be a buy the rumor, sell the news type of event, at least so far. Now, a lot of that could be tied to the upcoming elections next week. We also have all the unknowns with the stimulus. Are we going to have a stimulus plan or not? And then ultimately, a lot of focus right now is on what's going on with the virus, with this pandemic here. As the numbers continue to pick up, there's more uncertainty about whether we're going to get further shutdowns and how that's going to impact the economy here going through the winter months. As a result, when you get that type of uncertainty, markets don't like uncertainty. We have seen fear start to kick back in. It's starting to get priced in to this market. We track fear looking at the VIX, symbol VIX. At least briefly today, we got up above 41. Very unusual to see the VIX stay this elevated for this long. We've had the VIX elevated for most of this year, going back to the spring when the virus really started to pick up. If we take a look at the daily chart of symbol VIX, you will notice that anytime that we get up into this range here where you're in the 30s, lower 40s, if we go back and look historically, when you get these types of spikes, they don't tend to last very long. Spikes in the VIX will typically last for a couple days, maybe a couple weeks, if you take a look at historical patterns. To have the VIX above 20 now for the last 7-8 months, very, very unusual to have that happen. We're in historical type conditions at this point. How do we interpret that? How do we apply that to our trading? Where there's a couple of things that we want to point out. Number one, a VIX above 40 for any length of time is not sustainable. And in most cases, markets overstate fear. They try to price in the worst case scenario. And in reality, markets will normalize at some point going forward. What does that look like for us? When does that normalization happen? When do we see volatility start to contract? It's going to take more certainty after the elections. Right? Do we have a clear winner? Is a winner decided right away, or are we going to see this thing drag on for a stretch? Also, the unknowns with the virus, right? There's going to be that uncertainty now in the months to come. So my outlook for volatility, I think we're at a point now that the VIX over the last couple of days has gotten back up above 40, I do expect volatility to contract towards the middle second half of next week. I do think we will start to see things stabilize a bit, and I'll talk about what that looks like in some of the individual stocks that we trade in just a moment. When volatility gets this high, what does that mean for options traders like us? With volatility high, the options are very, very expensive. Right? You're starting to see that whether you're looking at the weekly options or the monthly options, everything is expensive right now because volatility has spiked. That does not mean you can't buy options. You just have to know that if you're going to buy an option here, you're paying up for those contracts. They can work as long as you get a big enough directional move in your favor. It's got to happen quickly. It's got to happen quickly enough to help prevent the time decay from picking up in a big way. Also, if the volatility contracts, even if you get a directional move in your favor, let's say the market does bounce. Let's say we find some support over the next week or two and we get this market back to the upside. During that stretch, in all likelihood, the volatility is going to contract, and that's going to cause value to come out of the options. Even if you are directionally right on the upside with long calls, if the volatility contracts too much, you're either going to make a lower profit or no profit at all, depending on how big the move is. So you have to have a lot go right in your favor when you're buying options when volatility is this high. You just have to be nimble. You just have to be cautious in how you utilize those. The better route to go, and something I've been doing quite a bit in my own personal trading, is looking for more credit spread opportunities. Selling a credit spread allows us to take advantage of the high volatility. When volatility is high, the options are expensive. When we sell a spread, we want to sell high with the goal of buying those spreads back at a lower price a couple weeks out. Instead of forcing one strategy to work all the time, like a long call, a long put, by having those credit spreads in our back pocket, now we have a strategy to go to. Even if the market is very active, very volatile, if the prices are too expensive, the credit spreads allow us to drastically lower the cost of the trades and give ourselves trades that have a higher probability of success. So that's going to be more of my focus in the next few weeks, because this week is a perfect example. We've had some pretty big swings back and forth. Ultimately, the trend has been to the downside, which you can see on SPY. The trend has been lower, but we've had a couple of pretty impressive rallies here this week, specifically what we saw yesterday, right? Those moves intraday, even though the overall trend is lower, some of these moves intraday are big enough to where if you're not careful, it's easy to get whipped around. And that's very frustrating for traders. I've heard from numerous traders here this week asking, Mike, what do we think about the markets? Is this the most difficult market you've seen? It ranks up there with one of the most challenging markets because it's so news driven, it's so headline driven, and these moves that we're seeing intraday are big. If you keep your stops too tight, it's really easy to get whipped around. So the credit spreads allow us to navigate through some of that choppy, some of that volatile back and forth movement a little bit better. They're just more forgiving type trades. We don't have the home run profit potential that we'd have with a long call, long put, but they're way more forgiving trades. And in this market, I want those higher probabilities. Even though we have the lower profit potential, being more conservative just with all the unknowns right now, I think is the smart, prudent thing to do. All right. So from a technical perspective on SPY, you can see that we did earlier this week break through some pretty key support levels. We broke through the 50-period moving averages up here. We talked about those last week, those orange, brownish colored lines there. And then we also broke through our blue lines there earlier in the week as well. The blue lines represent the 89 and the 100-period exponential moving averages. If we go back in time, if we look back earlier in the year, you can see that anytime that those levels have been tested, it has led to another wave to the upside. However, we did break those levels over the last couple of days, and we're actually seeing some follow through today. The next area of support that I am looking at on the downside is the 200-period moving average down at 319.19. Okay, we've got another $6 or so to get down to that level, but in this market, anything can happen. We could test that level very quickly, and if that level is tested, I do expect us to find at least some support initially. Not saying we won't break it, but I'd be very surprised if we just sliced right through that level. I'd be very surprised. I do expect us to see a bounce if we get down and test that level over the next few days. If we do find some support, or maybe we don't even get down to that 200 MA, maybe we do get a bounce or a rally attempt this afternoon. Maybe some news breaks this afternoon on the stimulus, or maybe some vaccine news. If the market bounces, areas that we're looking at for resistance, first areas, those blue moving averages, the ones that we just broke down through, now become areas of resistance on the upside. We've got a pocket there between 329 and 331. That's our first area of resistance. And then above that little block there, we also have moving averages anywhere from 334 up to 341. We got this whole cluster of moving averages there. So if the bulls are going to recapture control here and take this market higher, they've got their work cut out for them, because not only do we have resistance levels at all of these moving averages above us, we have also seen volume pick up the last couple of days, specifically on the downside. There has been more conviction on the downside. The attempts at rallies have not come on phenomenal volume. So we need to see, if this market's going to bounce, we need to see the volume stay elevated, and we do need to break up through some of these resistance levels here going into next week. The volume I mentioned, pretty good on the downside. If we go back to Wednesday's session, we are well above 120 million shares on SPY. That's a very good number. Here we are today. We've got 3 hours left to go in the trading day, and we've already had almost 50 million shares trade today. It's another very, very good number. There's good volume here on the downside. If we take a look at the internals, we can clearly see the Dow is down 300. The NASDAQ is almost down 300. The S&P is down 50. I mean, at initial glance, it looks like a very nasty market, right? The internals, however, give us a better glimpse into how strong or weak the market is. I like to take a look at the volume ratio. How much volume do we have on the upside versus the downside? If you take a look at both the NYSE and the NASDAQ, when I say NYSE, I'm talking about the New York Stock Exchange, and the NASDAQ, we've got volume ratios right around 3.5 to 1 negative. There's more volume on the downside than on the upside. On a trending day to the downside, I'd like to see that ratio at -2 to 1. So we've got that today. There's actually conviction behind the move. In the upper right-hand corner, we've got the advanced decline line. On the NASDAQ, we're at -1,700. That's telling me how many names inside of the NASDAQ are lower on the session. Is it broad-based selling, or is it just selling in a few key tech stocks? For me to see across the board selling, I'd want to get that advanced decline number at least -1,000. We've got that. It's -1,700. This is pretty much across the board. There's very few pockets of strength here today in the NASDAQ. And same goes for the NYSE. I mean, the New York Stock Exchange -1,200. There's very few green names on my watch list so far today. Okay, very key to point that out, because we've had sessions here lately where, we've had big moves intraday, but the internals really haven't backed the move. Today, the internals are backing the move, at least so far. We've had a few sell programs here on the tick in the lower left-hand corner. The NYSE tick, it tells us at that very moment in time how many stocks are trading on an uptick versus how many stocks are trading on a downtick. I want to see clusters of either +1,000 readings on the upside or -1,000 readings on the downside. Those indicate buy and sell programs. We've had 3 sell programs so far today, 3 -1,000 tick ratings. And you can see so far, it's been a pretty impressive move to the downside. We've had a few attempts here at some bounces, but every time we've had this market bounce, we've had those bounces sold. Very important to point that out as well, because in months past, when we get these sell-offs, we get almost an immediate V-shaped recovery. Well, so far, it's been more difficult for the bulls to take back control of this market. All that to say, there continues to be a lot of uncertainty going into next week. My outlook, my strategy for trading this market has not changed. I've talked about this the last few times that we've connected for these sessions. I'm continuing to trade in a more conservative way, more vertical spreads, smaller position sizes. I've been trading between 50 and 75% of my normal position size. I'm going to continue to take that approach through at least midweek next week. And until we get a little bit more direction on the outcome of the elections, I want to be more conservative here. Let's talk about some of the individual stocks on our list. Let's talk about the charts that we actually trade off of, because so far what we've talked about, the daily chart and the internals, I'm not using those to base my entry and exit points off of. I'm using those to help determine how aggressive or conservative I want to be. The charts that we're going to talk about next are the actual charts that I use to guide my entry and exit points. I like to use the 195-minute chart. It gives you 2 candles a day instead of 1. You'd get 1 candle a day with a daily chart, which is just too slow to react in most cases. I get this question quite a bit. Do I use the 195-minute chart exclusively? In most cases, yes, I do focus on this chart. The other one that I like quite a bit is the 130-minute chart. I've got that loaded up here as well. If I zoom out, the 195-minute chart is on the left. The 130-minute chart is on the right. The shorter the time frame goes, you have to be cautious there, because the shorter the time frame, the more prone you are to get caught up in noise. So I do use the 195-minute chart more often than not. So that's what we're going to focus in on here today. All right, let's start out with SPY. This is the S&P 500 ETF. If we take a look, you can clearly see over the past week or two, we've had this impressive move to the downside. It hasn't been the cleanest move. We've had some impressive bounces in here along the way, but the trend is clearly to the downside at this point. However, notice on my middle histogram here, we've got the last 5 bars plotting as yellow. That's what we call our pulse histogram. When I get yellow bars plotting on the pulse, it indicates that price is between a 1 and a 2 standard deviation move on the downside. That does not mean price has to reverse here. It doesn't mean price can't head lower. It just means it's not statistically probable. Odds actually favor either a sideways consolidation or a reversal in the other direction. If I go back in time, if we just take a look at the last few cases where we've had yellow bars on the pulse indicator, we had some yellow bars on the upside here back end of August, early September. When we have yellow bars on the upside, those indicate an overbought condition. And look what happened. It wasn't immediate, right? It took a stretch here. We continued to move to the upside for an additional week after those yellow bars started to plot. But soon thereafter, we actually never saw a period of consolidation. We saw an immediate reversal to the downside, right? We got oversold. We got overbought. It was not sustainable, and we got that sell-off soon thereafter. We then got a stretch towards the end of September where we had a slew of yellow bars on the downside. Now those indicate an oversold condition. And what happened once those yellow bars started to plot? We did get a couple of days of chop, and then we saw this reversal back to the upside. Those are very typical patterns out of these types of extremes. When I see yellow bars plot, what I am looking for is at least 3 out of the past 5 bars plotting yellow. So as soon as I get a yellow bar, like this one right here, or this very first one back here in August, that was not enough for me to come in and consider a new trade. I need at least 3 out of the past 5 bars plotting as yellow. Well, fast forward to the current conditions. We do have 3 out of the past 5 bars plotting yellow. That does indicate an oversold condition. And based solely off of price action, what we expect here over the next week or two is either some sideways chop or even a reversal to the upside. Now, I fully realize that all of the news events that I talked about a few moments ago still remain. It's easy to try to say, okay, price action is oversold, but Mike, the news couldn't be any worse. A lot of uncertainty there with the virus and no stimulus plan. I think the market's going to continue to head lower. That is a possible outcome. It's not statistically probable long-term. When I go back to some of these other overbought or oversold extremes back in August, when this market was zooming higher, it was euphoric. It felt like we were going to go up, make new all-time highs on a weekly basis, right? Didn't feel like the market was ever going to head lower again. Ultimately, what happened? We knew it reversed. We can see that it reversed. And then on the downside, back in September, we had the news flip. We had some negative news come out, and all of a sudden the market starts to sell off, and everybody's talking about, here we go. We're going to go test down the lows from earlier in the year again. Felt awful. And then the market reversed higher. So I point this out because you don't want to get caught up in the news cycle. Guys, today, following the news, you guys see it. It's dangerous. It's hard because the news is so negative. It's so extreme. Right? And a lot of that is just due to trying to get clicks, trying to get people to click headlines, and fear sells. Things are never as good as the media will make it sound when things are going good, and they're never as bad as they make it sound on the downside. We've got to focus on price action. Ultimately, all news is going to be priced into the market. So my outlook over the next couple of weeks is either to see a period of consolidation or a potential reversal to the upside. It doesn't mean I have to jump in with both feet and say, hey, I'm going all in bullish here. That's not the case at all. But using numbers and statistics to back up our outlook, I would be interested here in nibbling in some neutral to bullish positions. Okay. So the ultimate reason for that outlook is the pulse indicator plotting yellow. Could you wait for some additional confirmation? Sure. What would that look like? Well, if you wanted to lean neutral to bullish, but you wanted some confirmation in price first, this red and blue line moving across our chart, that's the 8-period exponential moving average. It plots red when it's moving to the downside. It plots blue when it's moving to the upside. If you wanted to wait for confirmation before you put on a neutral to bullish trade on SPY, you could wait for price action to close up above the 8-period EMA. That level is currently sitting at 330.16. So I wouldn't have any issue with that. taking a more conservative approach. I can't argue with that at all. All right. Let's just say for our purposes here today, let's just say you wanted to put on a trade now. Let's walk through how I would do this. If I were to come in and buy a call option here, it's too aggressive. Buying a call option is the most aggressive bullish trade you can put on. I don't want to be that aggressive because we know that even though the market's oversold, it doesn't mean it has to turn immediately. If we look back over that daily or that 195-minute chart, in previous examples, it did take a few days, potentially a week or two before the market turned. So what if I'm a little bit early here with my neutral to bullish outlook? I want a more conservative approach. And one way of doing that is to come in and use a credit spread, specifically selling an out of the money put spread. And here's how you do it. Let's open up the November monthly options. I talked about this on Wednesday in our midweek update. And I talked about how the monthly options are easier to trade in many cases because they have more liquidity. They have more volume and open interest. The higher the volume, the higher the open interest, the easier it's going to be for you to get in and out of trades quickly and at decent pricing. Not opposed to trading the weeklies here, especially on SPY. You can get away with it because the weeklies are very liquid as well. But there are certain stocks and ETFs out there where you open up the weekly options and there's not a ton of great liquidity. You want to pay attention to that. So we're going to take a look at the November monthly options. They have 21 days left to expiration. I am going to go to the put options on the right-hand side. I'm going to go to the out of the money puts. And I'm going to actually load up. Let's load up some additional strikes. When I sell a credit spread, doesn't matter if I'm looking at a call spread or a put spread, I ideally want to sell the option that has around a 65% chance of closing out of the money. If I go all the way to the 310 put, it's way out of the money. If I right click on the 310 put, go to sell and go to vertical, it's going to pop up an order down at the bottom. By default, it has a dollar wide spread where I'm selling the 310 put and buying the 309 put. I'm going to stretch that 309 put. I'm going to move it to 308. Let's look at a $2 wide spread instead of a $1 wide spread. Ideally, I would like to collect between 30 and 40% of the width of the strikes. There's a $2 difference between the width of these strikes here, right? $2 difference between the strike prices. I want to collect between ideally 60 and 80 cents. That would be ideal for me. So the current price of this spread is only 51 cents. It's a little bit light. I would like to collect a little bit more premium. And how would I do that? In order to collect more money, I've got to move the options closer to the current stock price. So what if I adjust the 310 strike to 312? And then I'm going to adjust the 308 put to 310. Now I'm getting closer. Now I'm at 54 to 55 cents. It's kind of bouncing back and forth there. I'm going to make another adjustment here. Let's go to the 314 put and the 312 put. And we're going to, it's kind of bouncing, price is bouncing back and forth in here. So I'm going to move the price to 60 cents just for our example here. Let's say we can get filled at 60 cents. If I hit confirm and send, here's what this trade looks like. I'm collecting 60 cents or $60 per spread, and I am risking $140 per spread. I'm right around a risk 2 to make 1. I am okay to risk 2 to make 1. I'm okay with that ratio because we've got 5 ways of making money on this position. I can make money if SPY moves up, down, or sideways. Don't care. As long as price stays above 313.40, I'm okay. We've got about an $11 cushion here where we can be wrong. The price of SPY is currently at 324.50. I can have SPY move down by another $11 and still be okay. The only move that hurts me is a big move below 313.40. We already mentioned the market's it's oversold in the near term. We've already seen a heck of a move lower. The odds do not favor another $12 move to the downside. Right? Doesn't mean it can't happen, just the odds don't favor it. I also make money as time decay adds up. Every day that passes, that helps me. And I make money if volatility decreases. We also mentioned, I talked about the VIX earlier. The VIX is elevated. It's almost at 40. The options are very expensive. Over time, the volatility is going to want to decrease. It's going to want to contract. And we would benefit from the volatility moving lower. Now we're taking the current conditions. We're taking volatility, for example. We're putting time decay. We're starting to stack some things in our favor. That's why I'm using the credit spread here. It's only tying up $140 of capital. So if you compare that, if we were to just come in and try to buy it, let's just say we don't want it to buy an in-the-money call option. If I buy an in-the-money call option right now to put on a bullish trade, you're talking about $1,200 per contract. They're expensive because volatility is so high. With this spread, we're only tying up $140. Now, all of a sudden, if you've got a smaller account size, you're not limited. You're not limited to trading the inexpensive stocks. You're not limited to trading the cheap out of the money options. You can put on a very high quality position, start to stack the deck in your favor, and give yourself a higher probability of success. We can lean bullish here. And again, if I am dead wrong on this trade, let's say this market, let's say we do get an outlier move. The markets don't like the outcome of the elections. They don't like the uncertainty. Let's say we sell off again. The most I can lose on this trade is $140 per spread. Fully risk-defined trade. Now, granted, our profit potential here is limited to $60. That's the most I can make on the trade. So do we have the home run profit potential? No, but if you do have the bigger account size, let's say you put this on with 10 spreads. You put it on 10 times, you've got $1,400 of risk, and now you've got $600 of profit potential, again, with 5 ways of making money on the trade. When you start to utilize these credit spreads, guys, it's just going to give you way more flexibility in different types of market conditions. That's why I love to use them. It's not something that I would go to exclusively. It's not something I'm going to use 100% of the time. But in markets like this, when volatility is active, you want to have this in your toolbox. If we do get volatility to contract, if things start to settle down after the elections, yeah, we can shift our focus right back over to trading more long calls, long puts. We can be flexible. That's the beauty of trading options. They're the most flexible financial products in the world. All right, let's take a look. Let's go back over to our 195-minute chart. Let's take a look at a chart of QQQ. Everything we just talked about on SPY holds true on the NASDAQ ETF as well. We've had a nice move to the downside. The system is still looking for, a continuation move to the downside, but we are starting to get some yellow pulse bars here. We are oversold, potentially looking for either a neutral to bullish trade over the next week or two. If you're not already in a bearish trade, if you're not already in long puts, this is not the time to initiate bearish trades, in my opinion. If you're already in some long puts, I don't have a problem holding a little bit longer. But as far as initiating new trades, I would hold off on any new bearish trades. I just don't think the odds favor those new trades at this point. So bearish here in the near term. However, we are getting oversold. So the potential is there for more of a neutral to bullish trade over the next couple of weeks. Apple had earnings out after the close yesterday. Currently down almost $7 on the session here. Down over 5%. So similar story. I talked about this on Wednesday. I did not want to carry any long option positions through earnings. Just not my style. Just too much has to go right in your favor around earnings. I mentioned how I was going to stay flat. And then as soon as earnings come out, okay, come first of next week, I'm going to look to get back on board some of these tech stocks. How would I do it on Apple? What am I looking for going into next week? Well, look at our pulse indicator down at the bottom. 3 out of the past 5 bars have plotted yellow. We're oversold in the near term. I would potentially be looking for a neutral to bullish trade come first of next week. I'm not going to do anything new today on Apple because the volume is through the roof. The daily range is wide due to the earnings that were out last night. I'm going to hold off, not do anything new on Apple this afternoon, but come Monday into Tuesday next week, I would certainly be looking for some new trades. And I'm going to potentially be looking at selling some put spreads here early next week on Apple. Netflix. Pretty interesting last couple of days on Netflix as well. It is also down today, down over 5%. But what was interesting is yesterday afternoon, we had some news break that Netflix was going to be raising their pricing. And on that news, the stock almost immediately popped to the upside by $30, $35. It was very short-lived. It lasted a couple of hours yesterday. And lo and behold, you can see what's happened. We're right back to the downside, making some new lows on this recent wave to the downside. Like Apple, like QQQ, like SPY, we are oversold in the near term. And please, guys, don't misinterpret this. When I say we're oversold in the near term and I'm looking for a potential bounce higher, I am not saying that the low is in for the year and we're going to just shoot right back to the upside. When I talk about leaning a little bit neutral to bullish, I'm talking about for the next couple of days and out to the next couple of weeks. I'm looking for a potential bounce to the upside. I'm not saying that we won't get a further wave lower here going forward. I'm just saying in the very near term, we're probably going to get either a period of consolidation or a bounce higher, just following the odds that we have seen previously. Netflix is also on my list going into next week, potentially looking for a bounce to the upside. I would potentially be looking at selling a put spread, following the same rules that I just talked about over on SPY. If you're going to sell a spread, I like the November monthly options here. I also like collecting between 30 and 40% of the width of the strikes. And if you follow that criteria, you can use it on any stock or ETF that's on your list. Let's talk about some of the financials. Let's talk about JP Morgan. The financials have actually been doing their best here today. They're down, but they're not down anywhere near what the tech stocks are. The reason I point this out is if you take a look at a chart of JP Morgan, we are oversold. We have the last 5 bars plotting as yellow on our pulse indicator. I could certainly see a situation where going into the next couple of weeks, if we do see this market stabilize, if we do start to see a bounce higher, I wouldn't be surprised if some of the financials lead that move higher. JP Morgan, the system is still in a bearish outlook in the near term based on, price action. You can clearly see it's been moving lower. But going into next week, this is also another one that we can potentially be looking at selling a put spread on. Just like on SPY, if you wanted to wait for some confirmation first, wait for price action to move up above the 8 EMA. I wouldn't have a problem with that. If you wanted to wait for a candle to close above that level, I'd be perfectly okay with that outlook. But JP Morgan is also on my list going into next week. Energy. Let's take a look at XLE. This is the energy ETF. So what I'd like to look for here, the other histogram down at the bottom of my chart is what we call our trend strength histogram. And when it's blue, it indicates bullish momentum. When it's red, it indicates bearish momentum. And you can see here, it's clearly been red here of late. But notice how that trend strength indicator fell below -6. It happened here earlier this week. When you start to get a trend strength indicator reading below -6, it indicates an extreme. It's also another way of identifying an oversold condition. When I see that happen, it has me potentially looking for a reversal in the other direction. In this case here, I like XLE going into next week, but I do want to see price action close above our 8 EMA. That red line. I want to see price action close above that level. If it does early next week, this is a potential opportunity to buy a long call. I want to trade a lot of credit spreads right now. We've already talked about a handful of those opportunities for next week, but I do want to also mix up my strategies. And if we do get a close above the 8 EMA, this is one that I would be willing to put on a long call. If I'm going to buy some long calls next week, I'm going to be taking a look at the December monthly options. I'm going to start to go out further in time. So XLE on my radar for a bullish position going into next week. The final one I wanted to take a look at is on Visa, symbol V. And you'll notice that the pulse indicator not only has gone yellow, but it's also printed blue and green. What do those indicate? The green pulse bars indicate price being between a 2 and a 3 standard deviation move on the downside. The blue bars indicate price being between a 3 and a 4 standard deviation move. In other words, we are extremely oversold in the near term. The odds very much favor either a sideways consolidation or a reversal higher out of this pattern. Doesn't have to happen today. It might take a couple more days, but the odds favor price action stabilizing here, potentially bouncing higher in the very near term. This is also on my radar for a short put spread opportunity going into next week. Could you wait for a close for price action to close above the 8 EMA? Sure. I wouldn't be opposed to that. but it's certainly on the radar for early next week as a potential candidate. Now, I mentioned on XLE, let me go back over to the trade page and let's talk through why I would be interested in going out to the December options. Going into next week, the November options are going to have less than 20 days left to expiration. I typically like to be in the 20 to 40 day window at a minimum. If you start to trade the options that have less than 20 days left, the time decay is extreme. It's a far more aggressive approach. Not opposed to that as long as it matches up with your aggressive outlook. If you start to go out 40 plus days out to December, you're still able to get a really high quality position. The time decay is still there, but it's not as significant. It's just a more conservative approach, and that matches up with my outlook. I outlined that earlier. I want to be more conservative until we get past the elections, until we have a little bit more clear direction on any type of a stimulus plan. I want to lean more conservative. So I've been trading the November options, the monthly options for the last number of weeks, but I'm going to start to transition farther out in time coming into next week. And we'll talk about that more on Wednesday next week for our midweek update. All right. Any questions on anything else that I have covered here so far today? If you have any symbols that you'd like me to take a look at, symbols that I have not covered, let me know. Go ahead and type those into the chat, and I can certainly do my best to take a look. My plan of attack for next week, continue to trade small, continue to focus on more credit spreads, and then ultimately, we'll keep a close eye on what the elections do next week as well. So I will be back on Wednesday. We'll jump back on Wednesday for our midweek update. If you have any questions between now and then, feel free to email me directly, mike@netpicks.com. You can always leave a comment on the video as well, and we are more than willing to help out. All right. So I'm going to start to wrap up here for the day, for the week. Enjoy your weekend, everybody. Enjoy your Halloween. Stay safe. Stay healthy. Do your best to stay healthy. And we'll talk to you guys next week. Thanks for joining us today.